Hi all. Welcome to the market outlook discussion for the month of March 2024. On the agenda, like every other month, we'll just revisit the education, that is our thinking framework. Then we'll move on to the earnings. How do the earnings look like? The valuations at this point of time and the expectations. Like we had discussed previously that earnings growth determines the 80% of returns, and for this we have taken example of 1995 to 2023. The Sensex had moved up 11% CAGR, and whereas the earnings had also grown 10% CAGR. So what we see is on a longer duration, your price growth ultimately follows the earnings growth. However, in short term, like for example, for the year 2005 to 2009, there might be volatility, and price earnings growth might not really move in tandem with each other. Moving on to our next principle, that is revaluation growth determines 20% of returns. Now we believe that returns are a combination of your earnings growth and your PE revaluation. That is for every rupee that is being earned by the company, how much is the investor willing to pay? So, for example, we have taken the example of Asian Paints that in 2014, the earnings growth of Asian Paints was 12 rupees, and for every rupee that was earned by the company, the investor was willing to pay 39. So, in short, the share price was 480 rupees. However, when we come to 2024, the earnings has increased to 57 rupees, and the P multiple has increased to 52. That is for every rupee that is earned by the company. An investor is willing to pay more, that is 52 rupees. And hence, the share price right now at this point of time was 2,950. So we see that the earnings have grown by 17% CAGR over the past 10 years. And there was a re-rating of multiple that is of 3%. And hence, we have gotten a return of around 20% over the past 10 years in case of Asian Paints. Now moving on to the earnings part. Now that we have got the results for the December quarter of 2023, we see that the YOY growth in case of BSE 500 has been coming down at 8%, which was in September 5%, and in June and before that was in the range of 14 to 18%. So we see that growth across all the large cap, mid cap, small cap is coming down, and we also see that the margins have now started decreasing. If we have to look at BSE 500, now it has come to 8.85 vis-a-vis 9.61. An interesting thing to look at will be the small caps, where the growth in YOY growth in terms of revenues has become negative. That is, if we compare December 2023 earnings to December 2022, we see that the earnings have come down by negative 7%. Moving on to the market valuations. Yeah, so on an overall market valuation side, in February we have seen overall across all the indexes, BSE 500, all large cap or mid cap, we are seeing that all the indexes are expensive right now, and only the banking index is the one which could be investable right now. On PR levels, our target is more than 5%, negative 5% of the growth is expected. On alpha over bond side, we are expecting an average of 15% alpha over bond. That too, a banking only is giving right now at 31%. On 52-week high levels, we are expecting that less than negative 6% devaluation from the market, which across all indexes no one is giving. And overall, if I need to conclude it, it's not good to invest right now. Moving on to the market expectations. Now here what we have done is we have taken the average price to sales ratio, and we have expected earning growth rates for next 5 years, which is 13% constant over your mid cap, large caps and small caps and your overall index. And currently, after looking at all the markets, mid cap is the most expensive one with only 9% price growth year on year. If you look at the history on the right side, it's been a little constant only. In Jan we were expecting around 11%, and now we are expecting 10%, which is not good at all, because we are getting same kind of yields on bond side also. On the bottom table, you will be able to see what kind of return that you could be expected out of the markets in year 1, 2 and 3 and going forward. So in year 1 we are expecting negative 1% return, as we forecast a good downfall from the market.
and from the coming years it could be 13% or more.